Most people think the nicest car on the road belongs to the most successful person. In reality, it often belongs to the person under the most financial pressure. What looks like wealth is usually a carefully financed illusion, and it's costing people far more than they realize. Have you ever been driving down the highway and suddenly found yourself stuck behind a truck so expensive it feels out of place in real life? Chrome everywhere, oversized tires, a price tag that rivals a small house. And for a split second, a thought flashes through your mind. How is this even possible? Here's the part that doesn't sit right. The person driving that truck probably doesn't make more money than you. In many cases, they make less, and yet, there they are, piloting a machine that costs more than the median household income, with a monthly payment that quietly exceeds what millions of people pay for rent. So what's really going on here? This isn't about jealousy. It's not about judging people for liking nice things. It's about a growing disconnect between what looks affordable and what actually is. Somewhere along the way, the definition of, "I can afford this," was rewritten. And most people didn't even notice it happening. That's what we're unpacking today. Not individual choices, but the system that makes financial self-destruction look like success. The kind of system that convinces regular people with regular jobs to reorganize their entire lives around a single purchase. All while believing they're doing just fine. This is Quietly Broke. Welcome. If you're interested in understanding money beyond surface-level advice, and you want to see the hidden mechanics behind everyday financial decisions, subscribe to the channel. Supporting the channel is what makes it possible to keep making thoughtful, honest videos like this. Before we go any further, I want you to think about one simple question. A. When you see expensive cars, you assume the owner is doing well financially. B. You wonder what they had to sacrifice to make that payment work. Comment A or B below. And once you start questioning that definition of affordability, the numbers themselves become impossible to ignore. Not long ago, a car payment was something you squeezed into your budget, not something that defined it. Today, the average new car payment in the United States has quietly crossed a line that would have sounded absurd just a decade ago. We're talking about monthly payments north of $700 for an average new vehicle. Not luxury brands, not exotic cars, just regular cars bought by regular people. When you look at trucks and SUVs, which now dominate the American market, the picture gets even more unsettling. Payments of $900, $1,000, even $1,200 a month have become routine. These are numbers that rival rent in many parts of the country. Yet they're being normalized as the cost of reliable transportation. Over the life of these loans, many buyers will hand over more money than the sticker price of the vehicle itself. All for something that starts losing value the moment it leaves the lot. What makes this so confusing is who's actually signing these contracts. These aren't hedge fund managers or tech founders. They're teachers, nurses, mechanics, office workers, people with stable but ordinary incomes who haven't suddenly seen their paychecks explode. Wages have risen, yes, but nowhere near fast enough to logically support this kind of financial commitment using traditional rules of money. And that's the key shift most people miss. It's not that Americans suddenly became wealthier. It's that the structure of buying a car changed. The numbers didn't get smaller. The timelines got longer. The focus quietly moved away from total cost and locked onto a single, hypnotizing figure, the monthly payment. When everything is framed around what you can manage this month, long-term math stops feeling relevant. A payment that looks survivable in isolation starts to feel reasonable, even when it consumes a dangerous percentage of your income. Over time, this becomes the new normal. People stop asking whether a purchase makes sense and start asking whether they can survive it. That's how affordability gets redefined. Not as financial health, but as endurance. And once endurance becomes the goal, the system has already won. Once affordability is reduced to endurance, the next question becomes unavoidable. How are these payments being made to look survivable in the first place? The answer isn't higher incomes or better financial discipline. It's a system that has quietly reshaped the mechanics of car buying to mask the true cost. The most powerful tool in that system is the extended loan term. What used to be a 3 or 4 year commitment has stretched into 6, 7, even 8 years, with some lenders now offering 10-year car loans. The longer the timeline, the smaller the monthly number appears. And that single number becomes the entire conversation. Spread a $60,000 vehicle over 8 years instead of 4. And suddenly the payment drops into a range that feels manageable. The buyer sees relief. What they don't see is the trade-off. Extending the loan doesn't make the car cheaper. It makes the damage quieter. Over time, that lower payment adds up to tens of thousands of dollars in additional cost. All while the vehicle continues to depreciate faster than the balance falls. Then there's the illusion of free money through promotional financing. 0% APR sounds like a gift. But it isn't. The cost is baked into the price. Buyers either pay full sticker price for the privilege of low interest or take a discount and accept market rates. Rarely do they get both. And the people who actually qualify for the best terms are often the same ones who could afford the car without them. The most dangerous mechanism, though, is the trade-in cycle. After a few years, many buyers want something newer while still owing more than their car is worth. Instead of confronting that loss, the negative equity gets rolled into the next loan. Debt from the past quietly joins debt from the present, creating a growing balance that never truly resets. Payments continue. Ownership never really arrives. From the outside, it looks like progress. New car, new smell, new identity. From the inside, it's a treadmill. The faster you run, the further behind you get. Dealerships love this structure because it creates repeat customers who can't easily exit. Once someone is trapped in the cycle, the idea of stopping feels more painful than continuing. That's the genius of the system. It doesn't require deception. It only requires focus. As long as attention stays on the monthly payment, the total cost stays invisible. And when damage is invisible, it's easy to mistake motion for progress. And once the mechanics are in place, the system doesn't just rely on math anymore, it relies on psychology. This is where extreme car payments stop feeling like a financial decision and start feeling like a statement about who you are. Somewhere along the way, vehicles stopped being framed as tools and became symbols. A truck isn't just transportation. It's proof you're hardworking, capable, reliable. An SUV isn't just a way to move your family around. It's evidence that you're responsible, successful, and doing life the right way. When identity gets wrapped around a purchase, rational analysis quietly exits the room. The automotive industry understands this better than almost anyone. They don't sell cars, they sell stories. Commercials don't focus on interest rates or depreciation curves. They show rugged landscapes, confident drivers, and families smiling in slow motion. The message is subtle but constant. This vehicle isn't about getting somewhere. It's about becoming someone. And once that idea takes hold, the payment stops feeling like a cost and starts feeling like an investment in your self-image. That emotional framing makes it much easier to normalize sacrifices that would otherwise feel absurd. People begin rearranging their lives to support the car. Instead of the other way around. Housing gets smaller. Roommates stay longer than planned. Vacations quietly disappear. Eating out becomes rare. Not because money is tight overall, but because a massive portion of income has already been spoken for. The car payment becomes non-negotiable, and everything else has to bend around it. For some, that bending turns into a second job. Weekends disappear into rideshare driving or delivery routes, often using the very vehicle that created the financial pressure in the first place. The car becomes both the burden and the justification. Others dip into retirement accounts, borrowing from their future selves to preserve a lifestyle narrative in the present. Credit cards pick up the slack for insurance, fuel, and repairs, quietly converting one form of stress into another. Over time, this creates a strange emotional attachment. The more someone sacrifices for their vehicle, the harder it becomes to question the decision. Criticism feels personal. Suggestions to downsize sound like insults. This is what turns a financial commitment into something closer to loyalty. Letting go of the car would mean admitting the story was wrong. And that's often more painful than continuing to pay. The most unsettling part is how normal all of this has become. Spending $1,000 a month on transportation no longer triggers alarm. It's explained away as necessary, deserved, or temporary. And because so many people are doing it at once, it stops looking extreme. It just looks like adulthood. But beneath the normalization is a quiet trade that rarely gets acknowledged. Time, flexibility, and future security are being exchanged for a feeling in the present. The car delivers confidence and status today, while quietly demanding years of constraint in return. At some point, without anyone ever saying it out loud, the relationship flips. You're no longer using the car to support your life. You're shaping your life to support the car. And once your life starts orbiting around a payment, the final question becomes unavoidable. What is this actually costing you? This is where the illusion finally collapses. Because the true price of an expensive vehicle has very little to do with the number on the loan document. The payment is just the entry fee. On top of it comes insurance that scales with the value of the car. Often hundreds of dollars a month for newer trucks and SUVs. Add fuel costs that quietly balloon with low mileage and long commutes. Add maintenance on increasingly complex machines where a single repair can wipe out months of savings. None of these costs feel dramatic on their own, but together they form a steady financial drain that rarely gets totaled up. When you finally do the math, it's unsettling. Over 7 years, a typical high-end truck can easily consume well over $100,000 in payments. Insurance, fuel, and repairs. And at the end of that period, what remains is an asset worth a fraction of what was spent to keep it alive. The money didn't disappear all at once. It leaked out slowly, disguised as normal life. What makes this even harder to swallow is the opportunity cost. That same monthly outflow, redirected elsewhere, could have built stability instead of stress. It could have reduced financial pressure, created options, or quietly compounded into something meaningful over time. Instead, it was locked into an object designed to decline in value, year after year, no matter how carefully it was maintained. This is the part no commercial ever shows. Not because it's complicated, but because it's inconvenient. A vehicle is framed as a symbol of progress. Yet the financial reality often moves in the opposite direction. The flashiest option on the road frequently belongs to the person with the least room to breathe. None of this is an argument for deprivation or guilt. It's a reminder of what cars actually are. They're tools, useful ones, sometimes necessary ones, but they are not measures of success. And they are not proof of worth. When a tool starts dictating your choices, your schedule, and your future, it stops being helpful. The quiet truth is this: real financial progress rarely announces itself. It doesn't shine, and it doesn't turn heads. It shows up as flexibility, calm, and the ability to walk away from things that don't serve you. And once you see that contrast clearly, the illusion of affordability becomes much harder to unsee. When you step back and look at the full picture, a pattern becomes impossible to ignore. Extreme car payments didn't become normal because people suddenly became reckless or irresponsible. They became normal because the system slowly taught people to measure affordability by pain tolerance instead of long-term impact. Monthly payments replaced total cost. Identity replaced intention. And convenience replaced clarity. The result is a quiet trade that rarely gets named. Time, flexibility, and future security are exchanged for something that looks like success but behaves like a liability. Most people don't realize they're making that trade because it doesn't feel dramatic. It feels ordinary. It feels like adulthood. But over years, those manageable decisions compound into stress, stagnation, and a constant sense of being financially cornered. The deeper lesson here is simple, but uncomfortable. If something requires you to shrink your life to support it, it's not serving you. Real progress expands your options. It doesn't lock you into obligations that dictate where you live, how you work, or what you can say yes or no to. So how do you apply this right now? Start asking a different question. Not, can I afford the payment? But, what does this choice quietly take from my future? Choose tools that support your life, not symbols that demand sacrifice in return. Financial freedom rarely looks impressive from the outside, but it feels unmistakable on the inside. Before you go, I'd love to hear your perspective. What matters more to you right now? A. Looking successful. B. Feeling financially free. Please comment A or B below so everyone can see how differently people think about this. And if this video helped you see money more clearly, consider subscribing to Quietly Broke. Your support is what allows us to keep making honest, thoughtful content like this.